But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. In recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. The next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really what I just mentioned, which is how long to keep policy restrictive.
Is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is, and we just don't do that.
Coming up today, Jay says progress on inflation has stalled. However, he won't hike rates and will instead boost liquidity, along with the Treasury as expected. We'll look at some seasonality data, a preview of Apple earnings tomorrow, the yen surges, and Bitcoin drops further. And welcome back to the Click Capital Daily Market Review, everybody. And what another interesting day we got this Fed Wednesday, in which Jay Powell admitted inflation is stalling. However, he specifically said the next move is likely not going to be a hike. Translation, he really doesn't want to hike. In fact, he's boosting liquidity to the system by reducing their quantitative tightening, the amount they reduce their balance sheet, along with a boost from the Treasury, all of which I'll show you soon. However, you could translate all of that into pretty much a pseudo rate cut. It's a form of loosening financial conditions, boosting liquidity, which the stock market initially reacted well to. However, we got a bit of a sharp reversal late in the afternoon. We can see that in the market color here. Back to red pretty much across the board. Even got the S&P and NASDAQ underneath the medium-term 50-day average now, and it's really utilities taking the lead here, uptrending across all time frames, and we can see that in my sector analysis chart, in which I've changed it to rolling 2-month returns. And you can see utilities at 9% is actually well out in the lead. In fact, there's only 3 other sectors positive in the last 2 months. That's energy at 6%, staples at 1%, and materials at 1%. And leading lower is tech at 8% and REITs at 8% as well. And in fact, just looking back from the start of the year, it's only energy and utilities where their rolling 2-month returns are higher than where we started the year. The rest of the market has been losing breadth. And just going down to the 5-minute chart on the SPY, pretty much as soon as Jay Powell said they're likely not going to hike rates, what I saw traders were really looking for today, the market shot up. However, it stalled out come 3 p.m. and rolled over and lost all of its gains going into the close. And just looking at the 5-minute chart on the 2-year government bond yield, it too sold off. After his dovish remarks, it did have a little bit of a bounce going into close here. And just before I move on, if you enjoy these videos and find value in them, then show some love and hit that like button, as it really does help out the channel and lets me know that you appreciate this content. So thanks to you guys for all your support. And so diving into the big events today, it's really the language and tone coming out of Jay Powell, in which he had to admit inflation has stalled. But you got to give it to him. He's the ultimate wordsmith, really knows how to frame things in a way that he tries to get the public to agree with him. Like, confidence on inflation decline will take longer than previously expected. And just looking at their latest official statement compared to the previous one from March 20, crossed out in the red, said economic activity has continued to expand, and what they recently added into this statement was, in recent months there has been a lack of further progress towards the committee's 2% inflation objective, and in the same statement mentioning that they're reducing the pace of the decline of their security holdings by reducing the monthly redemption cap on treasury securities from 60 billion to 25 billion. We were actually thinking it was going to go down to 30 billion. He actually came out 5 more billion dovish than what we thought he would. In addition to specifically saying it's unlikely that the Fed's next move will be a rate increase. That's really what got the animal spirits going just after lunch before reversing course. In addition to the liquidity boost from slowing the pace of treasury runoffs in their balance sheet. And here's a look at their balance sheet. So before COVID, they already faced a lot of criticism for how high it was at 4.1 trillion. They went and blew it out to 9 trillion. And in a strong economy, strong markets, you would think they would be able to bring it down even somewhere close to pre-pandemic levels. And they have reduced it to 7.4 trillion. However, that pace of decline is going to slow now. So it could be quite some time before it even goes below 7 trillion. And so it looks like he may have achieved his objective of talking down bond yields, and actually gave us an indication of what it would take for him to cut rates, which is a meaningful jump in unemployment, and specifically said a couple of tenths in the unemployment rate increase would probably not do that. So we're currently at 3.8%. He's saying if it bumped up to 4%, that wouldn't justify that. However, maybe above 4.2%, 4.3%, he may be able to justify a rate cut. And we'll get a look at the jobs market this coming Friday. And we did get a little bit of jobs data today in the ADP private payrolls, increasing 192,000 in April, coming in a bit firmer than expected at 183,000. And after we got the beat yesterday on wage price growth, that's cementing the trend in the employment cost, which has been trending higher the last couple of years. And that's a key input into inflation. If workers are being paid more, there's more money to spend. However, those workers are not spending more money because they want to, it's because they have to. Cost of their food and other basic necessities has gone up. And that's why even in a so-called booming economy, consumer confidence is dipping and people's expectations of the future is actually the lowest it's been in over a decade, and only really significantly lower in the bad economy of 2008 to 2011. And so the Fed and the Treasury are working in tandem together to boost liquidity to these markets, loosen financial conditions, and keep the party going at least for a few more months going into the election. And we saw that again today with the US Treasury holding back on increasing long-term debt in the coming months and going to buy back debt on the short end of the curve, thus reducing supply of bonds in the market, which also acts as downward pressure on bond yields, just like Jay's trying to do by constantly hinting to the market that he wants to cut rates and he doesn't want to increase. He's trying to talk down bond yields at a time we've got upticks in inflation. And so you can make of that of what you will, even though he swears it is not political. And some like Howard Lutnick says the Fed may even show off with one rate cut in September, and going on to say we're running a $1.8 trillion deficit, pumping money like it's going out of style into our economy, and inflation's going to be sticky. Obviously, inflation is going to be sticky. So just looking at the 2-year government bond yield, ever since Jay came out in October and pivoted to dovish, along with Janet Yellen's and the Treasury's actions, and reducing their issuance, they both managed to get bond yields down. However, their actions reignited animal spirits, got the stock market ripping to new highs, crypto, meme stocks, pumping up assets. That money flows into the economy as well, along with inflation expectations at a time we've had heightened geopolitics and commodities as well. And that's why the bond market's been reacting to that hotter inflation data over the last couple of months, much to the dismay of the Fed and Treasury. So they're coming out again, just like last time we were at 5%, and they're trying to work their magic. And it appears to have worked initially. The 2-year did dip down to 492 today. Did get a little bit of a bounce. And so what I'll be looking for next is this level here, around 480, to see whether the bond market does do what the government wants and drop yields lower, or maybe it continues to act in defiance of them and says, no, inflation is sticky, could be going higher, you may actually have to raise rates, even if you won't do that until after the election. And so it's a bit of an interesting fight here between the data, the Fed, and the Treasury, just like it had been with oil, had been running up on geopolitics, starting to flirt with $90 a barrel, adding to the upward pressure and inflation, decreasing Biden's chance of being re-elected, and looks like so far they're successful with their talking it down campaign, threatening to release more oil out of the Strategic Petroleum Reserve, even though it's at 41-year lows, and recently looking like they've been able to get Israel to cool things down, got a bit heated there with Iran, and looks like they're trying to get Israel and Hamas to the table to negotiate a ceasefire, as well as giving the political tailwinds for domestic producers to keep pumping it out, keep supply flush. And that's why we've been saying for a few weeks now that's likely to keep the pressure on crude oil. Next area of support, I'm looking around $78 a barrel. And if we don't get weaker, I'd expect it to at least consolidate for a little while here, as they do appear to be successful in getting the price of oil down. And what has been noticing these firmer bond yields over the last month or so is the previous leaders of this stock market. Last year and coming into this year, ripping really hard, AI stocks, semi-stocks, and the like have all really turned a corner here, along with crypto and other hot stocks like Super Microcomputer, MicroStrategy, all having significant pullbacks. And like I just showed you at the start of this video, it's now utilities leading, even more so today. I had been thinking we may potentially hit some resistance up here with these firmer bond yields. However, what I think's overwhelmed that is a bit of a defensive rotation, especially on today's candle. An above average volume, it's looking pretty strong there to my eye, and we may consolidate and move higher here. And utilities, as we can see down here on my trend strength, has been ranging for quite some time now, and markets don't stay ranging forever. That just sets up for a trend. And you just compare that to the chart of semiconductors, which up until about a month ago was the leading sector in the market. Ever since we got that big bearish engulfing on the 8th of March, it's kind of fell over a bit here, and even more so today, down almost 3% on huge volume, led by its biggest component, NVDA down almost 4%. And other semis really weak too. AMD fallen almost 9% today after yesterday's earnings. The previously super hot super microcomputer now well off highs that had got above $1,200 less than 2 months ago. Here we are at $738. And MicroStrategy. You'll find that crypto meme stocks correlate pretty strongly with liquidity and the risk on trade. And Bitcoin's only having a bit of a pullback here. However, I've already got MicroStrategy almost cut in half from its highs just over a month ago. And so my spread trade of long the Bitcoin Trust, short MicroStrategy, has been working out fantastically in that period of time as well. And there's a look at Bitcoin actually having lost that key support of 60,000 today, and it's actually looking like a bit of a head and shoulders topping pattern there on the chart, along with other previous hot stocks like ARM. So semiconductors, crypto, a lot of growth stocks really come off a bit here, and now energy stocks are as well. They had previously had a really big March going into April. However, with the government managing to get the price of oil down, it's having a material effect on energy stocks here. It's doing a bit better. There's also the defensive consumer staples. But like I said, it's really utilities. Actually breaking out to a 6-month high here on pretty good volume here today. So looking at the S&P 500, even though we almost got up to yesterday's opening price a bit above 51. For it to do this big reversal U-turn on what's pretty much a pseudo rate cut liquidity boost, along with that price action in semis and the risk-sensitive crypto sector, just shows this stock market is a bit heavy here, and we could be coming back down to test support under 5,000. Or if not, we could be in for a period of consolidation. And so just to run you through some seasonality charts and data, looking at the S&P 500 performance after we get a big start in an election year like we got this year. S&P pretty much ripped up straight out the gate, up 10% in Q1, and looking back at those similar years, it is a small sample size, there's only 5 of them. However, that's all we've got to work off. We can get a bit of weakness going into mid-year, then come summer in the Northern Hemisphere, market will find its footing and can potentially increase, and looks to get back to new all-time highs, but not too much further above where we got in Q1. And I wouldn't be surprised if the stock market follows a similar pattern as this as well. Just hearing from the Fed and Treasury today, they are fully supportive of the market, pretty much saying all dips should be bought, and the lower the market goes, if it were to go lower, they'll probably pull out more stops to get underneath it. However, given high inflation, it's probably unlikely we're going to have a big 20% year, and I'd say finishing up 11-12% would probably please most people out there in control. And like that chart shows, we could spend the next few months still on drawdown. In fact, most of the time, almost 2/3 of the time, looking at daily data from the year 1900, we're in a 5% drawdown almost 2/3 of the time. Half the time we're in a 10% drawdown, which we could still make over the next month or so. We've only done a 5.5% drawdown so far this year, but I'd say it's very unlikely we get anything more than a 15% drawdown, barring any major surprise. And since it's the 1st of May, I'd like to show you some stats. And so there's an old adage in the stock market, sell in May and go away, come back in October, and that's based on solid stats, that 6-month period from May to October is the lowest performing period significantly as well, averaging 1.7% change and higher about 65% of the time. You compare that to the best performing period of November to April, stock market will go up on average about 7% in that 6-month period, about 76% of the time. And this data here is actually a good argument for the easiest way to increase your win rate when investing in stocks is just to simply hold them longer. On any given month, the percentage that it finishes higher, it's only a little bit better than 50%. However, the longer you hold your stock, and especially paying attention to some seasonals, and if you buy good quality stocks on the dip and simply hold them for 6 months to the year, then you can give yourself a good 70% chance or so that it could be higher. However, I digress. Let's get back to seasonality. And that stocks don't always sell in May, especially lately. Just looking at the past 10 years, that sell in May, come back in October, didn't play out like it has done over the last 100 years. In fact, that 6-month period on average delivers a 4% return and is higher 80% of the time. Just keep in mind, we're still in a secular bull market, and that's why those stats are a bit skewed. And just looking at S&P data going back to 1950, May typically is a soft month. Even in an election year, returns are pretty low. Past 20 years, they're not so great. It's just in the past 10 years, they're a bit better, but still a lot better than the months of February and September. And so what about sell in May in an election year? Well, it's not so bad a return either. Average 6-month return after May is 2.3%, higher 77% of the time. So like I said, all the data points towards a bit of softness, consolidation at least. We may dip down, take out 4,900, and maybe go down to 4,600, give us a 10% drawdown for the year. But then I'd expect the Fed and Treasury to come out and support that market, draw a line in the sand saying we've had our 10% drawdown, thank you very much, let's finish the year higher. Also weighing on the stock market this week is making our way towards the halfway mark of Q1 earnings season, with Apple set to report tomorrow. Been getting mixed results from big tech earnings lately. Wall Street's expecting Apple to come in with quarterly revenue of $90.3 billion, earnings per share of $1.50, gross margins 46%. We'll be looking to hear commentary from them about China, how the new Apple Vision Pro's going, production on the new iPhone 16, and maybe they'll try and come out and speak of something to do with AI, as they've really been lacking in that area. And there's a look at the Apple Daily going into earnings tomorrow. Pretty soft here in a technical downtrend. It'll be interesting to see how the market reacts to the numbers, because even Microsoft came in with good numbers last week. Market still sold them off and still pretty technically weak here. I'm still looking at Microsoft for a bit of a dip buy if we get down to low 387s. We don't hear from NVDA until 21 days from now. Amazon was yesterday, and they came in with pretty good numbers, pretty solid beat there, 16%. Market was pretty much flat on them. Really Alphabet, Google, the real standout. Market loved that. Buyback, dividend. Gapped them up, however, we've pulled back a bit here. That too could also be setting up for a bit of a dip buy soon, maybe down in the high 150s if we get there. And Tesla, they came in with bad numbers, but the market shot them up, gapped up again on news of FSD rolling out in China, and we're pulling back a bit here as well. However, it's a bit hard what to make of Tesla here, because their numbers and business are a bit weak, facing headwinds. However, it's Tesla stock, can just pretty much do anything, just like we saw this Monday, gapping up over 15%. And as I was thinking last week, looks like we may have hit a bit of a blow-off top in the yen, as the BOJ's clearly intervened, trying to put a floor under their sliding currency, and we can see that on the chart in the dollar yen. After this huge spinning doji on Monday, we did a little bit of a retracement pullback, and in today's session came off hard. A lot of volatility there for the world's second most liquid currency. And just looking at economic data we got today, in addition to the ADP employment change coming in better than expected, manufacturing PMIs are a little mixed here, pretty much coming in line as expected. JOLTS job earnings a little lower than expected. There's that huge bump up in crude oil stocks. Suppliers flush. It's helping to keep a lid on the price of oil as well. Going into tomorrow, get a little bit more jobs data on unit labor costs, jobless claims, and then the big one Friday, non-farm payrolls and unemployment rate. And in response to Jay's commentary today, Fed Fund Futures actually pulled forward the chance of a Fed rate cut to November. Yesterday we were looking at December. It's only a couple of days ago it was September. The market's moving around a bit here, and its expectations of what the Fed's going to do really depends on these next CPI and PCE data prints we get. They're really going to sway things probably more than usual over the next coming month or two. And fear and greed index still in the fear zone at 40. There's the VIX whipsawing a bit there today, coming off then popping right back up. Chinese stock market still the best performing market this year. There's a look at Tiger Brokers coming up, kissing the 50-day VWAP there today. Sizable pullback in cannabis after that monster candle yesterday, up 24.8%, snapped right back to its 50-day today, down 15%, just showing how crazy and volatile this sector is. Probably a few games being played in there by algos as well, shaking out a lot of small traders. Would expect this candle low from yesterday to hold though, given the positive development that we're about to hear rescheduling from the DEA. Another favorite stock of mine, AMARC Precious Metals, looking close to breaking out to fresh highs again. And there's a look at some big financials, kind of just having a soft pullback, but still hanging in there around their 50-day VWAPs. All right, guys, there we have it for this Fed Wednesday. So to summarize, it was pretty much a pseudo rate cut, specifically saying it's unlikely they're going to hike rates, even though he admitted inflation stalling. Still talking about rate cuts, reducing the decline of their balance sheet reduction. It's a form of liquidity boosting, along with the Treasury buying back bonds as well, which should have been supportive of the market. If we got a big green candle out of that, wouldn't have been surprising. However, we were getting a green candle, then it just turned around, and we didn't get that huge pop out of bonds, as you'd expect as well, and which should have been a sharp reduction in yields. So maybe the bond market's skeptical on what Jay's actually saying, and could be just hanging in there and pointing to the fact that loose monetary conditions are likely to stimulate inflation again, at which some point they'll have to hike rates, as much as they keep kicking the can down the road. However, what will help inflation is that pullback in crude, and like I showed you, those risk-on assets, semis and crypto have already been coming off. And now it's the defensive sector of utilities taking the lead here. Thanks very much for joining me today and listening to my analysis. I hope that's of some value to you, and I look forward to making another video for you again tomorrow. Cheers.